All right, everyone, welcome back. This is Long Reads Live. This is the second edition of Long Reads Live. We just had our first last week. It was super fun. For those of you who haven't seen it, the idea is really to get the most interesting ideas in crypto talked about by the kind of the most interesting people in crypto and the people who are kind of driving those ideas. And so the way that we do this is that every week I have a guest host who comes in and joins me for the whole time. And then we bring on every 20 minutes a new guest who kind of adds to the conversation. And by the end of it, it's a big round robin. And so tonight I'm so excited to have Jake Brukhman here as my co-host. Jake, welcome.
Thank you, Nathaniel. I'm very happy to be here. Thank you for having me on.
Yeah, man. Awesome. So for those who don't know you, I guess let's just start with a little bit of background. Tell us about yourself and Coinfund and whatever else is relevant.
Sure. So my background in general is mathematics and computer science. I worked in kind of the hedge fund world here in New York for about 4 years or so, and then switched over to pure tech at Amazon. I was an early adopter of Bitcoin, and then started Coinfund as one of the first US-based crypto funds back in July of 2015. So me and my team, we've been investing in the space for over 3 years. We have a long resume in blockchain of working with projects, helping to design crypto economic systems and things like that. And of course, investing in blockchain companies and decentralized networks.
Awesome. Cool. So part of what, so over the last, I don't know, I guess 15 weeks ago, I started this thing called Long Read Sunday, which was sort of the genesis for this. And each week, basically what I do is I kind of spend the week looking for the most interesting content I can find. And there was a tweet that you put out a while ago that really I found just super interesting. And it was one of these things that I almost immediately kind of got stuck in my head. And so I want to pull this up actually for everyone to see. So it was part of a larger thread. So I've been thinking a lot about the theory of crypto funds. It now seems more clear that our role is to transcend the investor and to engage in the networks themselves, maybe and integrate with them. When Jonathan asked for clarity, line between investor and service provider is blurred. So this is kind of a simple but profoundly interesting idea, right? And so I wanted to see, I guess let's talk for a second. First, what got you walking down this path? Are you guys at Coinfund thinking this way? And then kind of what's happened, what's transpired since then?
That's a great question. So I'll try to cover it. I think what got us into it is, really just kind of being in the space from the beginning and watching sort of this concept develop of decentralized networks, right? And when decentralized networks, even like pre-blockchain, we've seen some decentralized networks in the form of peer-to-peer file sharing networks and Napster and Kazaa, and then we get the first decentralized network that can transfer value, which is Bitcoin. And what you see in this network is that there's this clear set of participants. There's sort of like users and there's miners. And then the users, put in transactions to the network, and the miners process those transactions. So the interesting thing about that is because Bitcoin is decentralized, because there's no central party, it had to incentivize a whole group of third parties to essentially operate the network. And those third parties are miners. Now, when you start to follow this space, right, the next kind of point in the progression is proof of stake networks. And suddenly you get this new kind of participant. You have what are now called validators, which is the analog of miners. You still have users, but now you have this concept in many of these networks called delegators. And delegators could be users, but they could be kind of like speculators or investors. They're just trying to make a return on their stake. And yet the function that they perform for the network is also incredibly important. Namely, the role of delegators is usually to select validators and to make sure that those validators are following the protocol, and to remove validators that are not, right? So in a sense, delegation is kind of a security mechanism for proof of stake networks. Now then things get even a lot more interesting than that. Bitcoin and Ethereum, they're kind of platforms, right? They are like a basic cryptocurrency and a quote unquote basic, smart contract platform. But what we're now just starting to see the beginnings of in blockchain are networks that are about to be performing all of these different kinds of domain-specific services, right? So suddenly we have Filecoin, which is doing decentralized storage, and a bunch of companies in that space. We have, you know, a good example would be LivePeer, which is another resource network that does video transcoding. We have examples in social media, like Steemit, right, where people post content, and then it's the job of the other participants to sort of, you know, curate that content and get the best content to the top. And really, like, what we want to do is we want to try to extrapolate, like, what does this look like in the long term, and really what is the vision for decentralized networks. And there's only like a few people that have been able to articulate it quite well. If you read Jacob Arluck's article called "Blockchains Are Not Startups," you know, somewhere in there he has a quote, I'm paraphrasing, but you know, he says that, like, blockchains are best understood, or I should say decentralized networks are best understood as institutional technology that increases the amount of coordination on the web, right? And basically, what the future of decentralized networks kind of looks like, I think, is that, first of all, there's many of them. They're all operating in different kinds of domains. They're global technologies, they're open technologies, and most importantly, they're decentralized technologies. And so this is not a corporation that can just hire, you know, an engineering department or a compliance department. These kinds of decentralized networks need to take third parties and incentivize them to perform critical network functions, right? And so you start to go to these other networks. You, like, look at Steemit, and you're like, well, what are the participants there? Well, the participants are content creators and content curators, and content curators can get rewarded for the service of curation. You look at, you know, I was just giving a talk on this topic at the Polkadot meetup, and if you look at how Polkadot works, it has 4 different kinds of participants. One of those is called a fisherman. A fisherman is a network participant that submits proof of wrongdoing that they witness in the network, and therefore they're a security mechanism in the network. And, you know, I could talk for hours and hours and hours, but, you know, LivePeer is an example where there's like 5 different kinds of participants. You know, investors, users, transcoders, miners. Now there's a proposal for orchestrators, and so on and so forth. And what you start to realize, and then I'll shoot it back over to you, Nathaniel, is that all of these networks need these third parties to perform valuable services that make these networks function. And that, to me, you know, became sort of the vision of what I call the generalized mining space. In other words, there's going to be a giant set of opportunities throughout these networks to either provide hardware, to provide software, to provide security, to provide governance, and in the long term, to provide a long list of domain-specific services that make these networks function. And then I asked the question, well, what is the role of the fund in that? Like, is a fund going to be provisioning hardware nodes? Are they going to be provisioning software nodes? And that's what this discussion is kind of all about.
Awesome. Yeah. So it's, I mean, it sounds like if we want to abstract it a layer up, the real shift is that in a traditional venture model, you have, you know, a venture capitalist can inject the kind of the resource that is most needed, that is separate from the team, which is capital, right? And theoretically, they're investing in a team that's capable of going and building the thing and doing it on their own, and grows the team accordingly, and yada, yada, yada. And despite all insistence to the contrary, I think most entrepreneurs mostly just want the capital that venture capitalists provide, not all the other things that come with it. The difference here is that we're talking about building networks, and we're doing so in a way where networks have a set of different actors who have very different specific relationships to the network and who make it work. And so the question then becomes, well, what does the network actually need to work and thrive, right? All of these are kind of network building activities to some extent. And so then I guess it's natural then for you to go to the next place, which is, what, you know, which of those activities is the fund supposed to do? So let's kind of take it from there. So I think, actually, I guess let me ask a question first before I go where I was going. Mm-hmm. So the first question is, one, as you look across this set of roles, of generalized mining roles, call it, that need to happen, which are appropriate for sort of people who are traditionally thinking of themselves as capital or investors to play versus roles that don't make sense or are different types of domains?
Yeah. So this is where it gets really interesting, because it seems like the space is kind of motivating investors to be a lot more technological. And so in a sense, it's not, in a sense, it's sort of like maybe saying like, hey, investors, you should actually, add value, and that value might go beyond capital, and that value, or sorry, those activities might represent kind of things that you really haven't done in the past. To zoom out for a second, I think the first step in understanding this space is to sort of make sense of it and then try to see like where might investors go. So the way that I make sense of it, and and I admit this is like a bit of a generalization, a bit of a simplification, but it really like helps me think about the space. And so I think about it as, if you were to like line up all of the opportunities in this space of how you can interact with these networks, you end up coming to a kind of very hardware intensive things on this side and very software intensive things on this side. I'll give you an example. So if you're like proof of work mining, you're spending $100 million in a data center, you're competing on kind of like how much hash power you have, and you have like relatively little proprietary software, right? You might have some to like help your data center run smoothly. If you're all the way on the software side, what you're doing is you're like coming up with really interesting proprietary software algorithms. This might be like curation algorithms or market making algorithms. Or in the case of Augur, you might be creating a market provisioning algorithm, trying to anticipate which markets are going to be the most popular. And this requires a lot of proprietary software and relatively little hardware. It's something you could just run on a computer or deploy on a commodity AWS machine. And then there's like a band in the middle where it's a little bit of both, right? And this is what I kind of see as the staking space, the way people understand it today. This is where a team doing a network, they're giving you the software of the node. So you're not necessarily writing a lot of proprietary software. You might, but maybe you're very focused on sort of the hardware security, as in the case of like the Cosmos network, right? And so you get a situation where you might write a little bit of software, and the hardware might be like dedicated and more expensive, but you're kind of in the middle. And so what do you see? So in the hardware space, right, you have these traditional proof of work miners. They're now looking at these networks and saying, hey, we can repurpose a lot of our hardware and compete on essentially capital, how much hardware we have, right? And they're coming in from this side. And in the middle, where you have the staking operations, you sort of have a number of staking companies that are coming out to market right now, and they're setting up nodes on Tezos and Cosmos and looking at these other staking networks. And their business model is delegation, right? They want to get as much delegates to their nodes as possible and then take a commission on that. And they are competing on efficiency, right? This is going to be a highly commoditized space. They're going to, like, whoever has the lowest fee is going to get the most delegation in theory. And then on the software side, this is really kind of a mostly unexplored space today. And who you see coming in from that side would be like quant traders, right? From the traditional, finance world, and maybe funds, right? So that's sort of how if you break up the set of opportunities this way, I see funds coming in this way, miners this way, and staking companies kind of in the middle.
That's really interesting. And so, I mean, I guess, do you view it, how different is the process of deciding which networks to make bets on or which projects to work with from a capital allocation versus sort of a work allocation standpoint? Is it the same process, just extended? Is it something where it actually changes the calculus because you feel like you have more ability to actually design for the, or influence the success of a network?
That's a good question. I think like at this stage in the game, we're still kind of at a point, especially wearing an investor lens, that really like any of these opportunities that you undertake is an investment decision. Why is that? Mm-hmm. Well, take a look at something like Cosmos or Tezos, right? You have a staking system, and it's going to get you something like 10% token denominator ROI, 20% token denominator ROI. But the real reason why people are very excited about those two networks today is not because they're like excited about making 20% on their tokens. they believe that the network is going to grow and it's going to become a major, multi-billion-dollar network. So what they're doing is they're really betting on the fiat-denominated return. And so when that matters a lot more than the ROI of staking, then what you're doing is you're making an investment decision to go into that network, but then you're trying to maximize your exposure through this kind of activity and just getting more tokens, right? So I think like these opportunities also, they present different kinds of risk reward trade-offs, right? Like if you're mining, then you're putting in a lot of capital, you're making like kind of a tiny ROI, but you're doing it at scale, right? If you're on the software side, then you are maybe spending a lot of money on R&D and developing these algorithms, and ultimately you're betting on these like very, very early networks, but those networks present like a huge kind of return potentially in the fiat denominated sense. So I think like right now, all of these are investment decisions. Like I don't think people should be staking or performing these services on networks that they don't truly believe in. And then I think over time, as like things stabilize and they get more commoditized, then you're thinking about these opportunities as like, especially like in a staking side, right? These are like kind of like savings accounts, right? I have this asset, I want to put it to work, I want to return on that asset, and the token denominated return is going to matter more than the fiat denominated return at that point.
How are you finding like what is the state of this thinking relative to other sort of crypto hedge funds, crypto investment peers? Like, is this becoming more common? Is it still, you feel like you're kind of out there in the weeds a little bit? Like, I mean, I'm interested to see what the response has been, because obviously this is a conversation that you've been having kind of in public, which I think is really, really cool.
So what's really, really cool is that a number of funds have realized that this is a worthwhile area to think about. And that might come, I can talk about the reasons why funds might want to do it, but basically we've had a number of funds, Notation Capital here in New York has done some work on Live Peer. Fabric Ventures out of London, who is invested in Ocean Protocol, recently announced with a post they're going to be looking into it. Of course, you have Multicoin Capital kind of running an EOS or in partnership with an EOS block producer, and a number of other examples. So it's something that I think is natural that funds will fall into. And the question is like, well, why might funds want to do this? Well, first of all, it's just an obvious value add to generating returns. If you have capital that you can relatively safely put to work, then it almost becomes your fiduciary duty to make those returns on behalf of your LPs at worst, or at best, if other funds are doing it, it's a competitive sort of differentiator, and then you might have some competitive pressure to compete with that, right? Another reason is like if you can go to a team that's building a network and you can say, hey, not only can I put my name behind you, not only can I give you capital, but I can actually also add value directly to your network. That is an access obtaining kind of proposition. I'll give you an example. Like in layer 2, right? I'm thinking state channel payment networks. A lot of the throughput of the network is equal to the capitalization of hubs on that network, right? So I, as a fund, can go and kind of purchase equity that is backed by some company's, hub, or I can run my own hub, put my own capital in it, and therefore like maybe double the throughput of the network. So that's valuable to the network. And then I can say I, as an investor, am actually adding value to the network, and I'm making a direct return because I have direct exposure to that network, and that's compelling.
Yeah, it's really interesting. I think one of the questions that I'm interested in, which I feel like we may get into more when Meltem joins, is this question of, so the fiduciary duty piece is particularly interesting, and just how diverse we're going to actually see strategies in the context of these crypto funds. Hey, welcome.
Hello, can you guys hear me okay?
Yeah, hey,
yes.
Meltem.
Oh, I didn't realize we were doing video.
We are. It's optional always, but we're all jamming on video.
Okay, hold on. Let me see. My husband's in the living room watching some HBO show, but Bluetooth headphones, best gift ever. So give me 1 second. I'll go sit in my little tiny New York home office. Where are you, Jake?
I'm over in Williamsburg, not too far.
My least favorite part of Manhattan.
Hey now.
All right, hold on.
There you are.
Oh man, that is a scary look. All right.
It's my Halloween theme.
It's Halloween themed WeWork booth.
All right, how are you guys doing tonight? What did I miss?
Good. We were just riffing on where you came in was actually a perfect segue to something we're going to talk about, I think, a little bit with you as well. We were just talking about this idea of generalized mining and funds participating in the full variety of staking and other types of services that are network building, and what that might eventually mean in terms of fund diversification and where different people allocate and things like that. So obviously that's something that we had kind of talked about, maybe riffing on a little bit, building off of your thread from this week. But maybe do you want to just start by, for those who don't know you, giving a little intro, and then I want to hear about CryptoSprings, man. I was very jealous to not be there.
So thanks for having me on, first of all. I'm really excited to be here. Nathaniel and I have exchanged a lot of words on Twitter, and I feel like it's a very crypto.
Padding.
Oh, we know each other because we talk on the internet, but a lot of times you don't really get to know people in person, so it's always nice name face. So my name is Meltem Demirors. I've been in the crypto ecosystem for the last 4 or 5-ish years. I started my sort of professional foray into crypto working on a company called Digital Currency Group that some people who are more on the startup or investing side are probably familiar with. It's a company that invests in companies, builds companies, etc. And so spent 3 years there doing that, oversaw the development side of our business, invested in over 120 companies while I was there, which was really cool because I really got to have a sort of ground level view into a lot of the companies that are now the largest companies in our space. And I think it's sort of fun. I call myself like the grandma of crypto because I feel like I've gotten the longest, probably linear time-based view of what's going on in a lot of these different businesses across the world as a result of being at DCG, which is, I think, really, really cool. And then I left in January, and now I invest on my own in companies and protocols. And then I recently joined a company called CoinShares. That's an asset management business. We serve retail and institutional clients. And my focus as of late has been helping to institutionalize the crypto asset management space. A lot of firms, projects, and even some funds out there who are really new to this world of how to custody, how to manage something like a cryptocurrency, especially as Jake and I have actually talked about a bit, especially when there's network participation involved, when there's inflation, when there's governance tokens. I think a lot of funds that have traditionally been speculative investors are really grappling in a world where you actually have to participate. What does that mean? And I think we're also starting to see protocols actually shift to selling governance tokens, which is one of the things I talked about at CryptoSprings. It's one of these fundamental challenges. Speculative investors are not users. So how do you balance, as someone who's creating a protocol, someone who's building a community, how do you balance the different needs or desires of speculative investors who seeded your project, token holders, people who are building applications? There's kind of this multi-layered incentive structure that we're just starting to figure out. And I think we've seen some recent examples of where conflict might exist. So I'm interested in untangling that further. I know I come off as critical and skeptical, but most of the skepticism is in fact directed at myself as an investor and someone who deeply cares about some of the ideologies and political goals of these protocols.
That's awesome. Yeah, I don't know. I find it interesting. The people have this sort of sense that there's, I don't know. For me, one of the things that I think is pretty amazing is the intensity with which people feel and debate things in this space is like, this is an incredibly positive thing. Coming out of spaces like advertising, where I spent like 5 years trying to teach brands about what technology to care about, including Bitcoin and things like that. It's just no one argues with you because no one cares, right? So I think, I don't know, we kind of overstate the degree to which being critical and just even having disagreement is a bad thing. But so, okay, so actually speaking of which, I could go way deep on and I want to, on the sort of this idea of the array of new types of actors who are coming together to build networks and what that means. Let's I really want to hear a little bit about the tell what CryptoSprings was, what its goal was, and I guess like I feel like the space has gotten so big and so dense and so crowded now that you don't have concentration. You can't read an event as kind of like the vibe for the whole space. But I feel like there have been a few this year that are actually still pretty good benchmarks for understanding what people are thinking and feeling. And I feel like the one of the things that was really cool to see with CryptoSprings was the cross section of people who were there, which really ran the gamut from kind of like Bitcoiners to people who are really interested in, what Eric Thornburg called tech crypto. There was a kind of a really cool cross section. So I'm interested to see whether there were big, what the vibe was and whether there were big themes that were coming out across lots of dimensions.
Yeah, so let me go back and kind of start with the intention. So I remember in 2014, 2015, going to Bitcoin, like nothing else, just Bitcoin meetups and conferences. And they were really cool because you didn't have some of the vibe you have today where people were like really angry and kind of, I think people today are kind of insulting almost. I'm like, I'm fine with people disagreeing. I actually love conflict and healthy debate, but I think like sometimes in crypto it crosses a line to disrespect, especially in online forums, which I think we've seen a lot of that this year. People get like really salty and take things very personally, and maybe I'm a bit trollish, so I add to that. But what we really wanted to do was kind of go back to that crypto community we're all a part of. So particularly Elizabeth Stark, Stacey Herbert, and myself, as we started thinking about it, we're like, okay, when's the last time we went to an event where one, we could actually talk to everyone there? I think most events today just feel like this cacophony where everyone's just trying to get everyone's attention and everything feels like rushed and you're running around. It's very discombobulated. You're just running from event to event. Everyone's like, oh, what party are you going to? Did you get invited to this? And I'm like, let's not do that. Let's throw something where everyone's included in everything. Everything is for everyone at all times. The other piece was we really wanted to bring together speakers from different disciplines to talk about what's actually being built rather than like partnerships and announcements. So we kind of had a strict like no announcements rule that we enforced, which was fun. And then the last component was, I think everyone in this space has so much to offer, regardless of whether they're a speaker, an attendee, volunteer, whether they're completely new and they're just observing what they're learning. We really wanted it to be extremely interactive where everyone who came could add to the conversation. So the mix, it was 250 people. We picked Palm Springs because there wasn't anywhere else for people to go. We didn't think people would like have meetings with anyone other than the attendees there. And we did it at the Ace Hotel, which is like super chill, has a very low key, like 1950s motel style. So it was really fun and relaxed. I wore all the caftans I own, which is like 2 more than I thought I had. But it ended up being a really great event. The first day we focused on, we didn't do any panels as well. Sorry, that was the other key thing is I think panels tend to be really boring because people just agree with each other and no one says what the fuck they think. So it's like, I don't want to sit here to watch like some watered down bullshit being spewed on this stage where people don't feel like they can authentically be themselves. So it's like, let's not do that. Let's give people 20-minute talks. And we actually ended up doing 25 20-minute talks and 4 40-minute panels that were like really short. And so the talks were really broad in range. We had more technical talks the first day. And when I say technical, I should say more engineering-oriented talks, where I think 2 of my favorite talks were Tess Renierson from Interstellar spoke about different types of consensus algorithms and did this really cool mapping of how they work and how they all fit together. Kathy Young, also from Interstellar, did a great talk on bulletproofs. Julia Fonti, who I was really excited to have there, did a talk on Dandelion, which is a privacy-preserving technology for Bitcoin. And then on the second day, we shifted gears a bit and we talked more about what's coming next for crypto. So we kicked off the day with Bram Cohen talking about the cypherpunk roots of Bitcoin and the fact that like all of these implementations of digital currency have been tried before. A bunch of them failed because they were centralized. And what's great is Matt Corallo then followed him with a talk on decentralized decentralized mining, and his point was exactly that. Like, we tried all these things, they failed. We don't seem to want to learn from history. And so I think the second day kind of set this great tone of like, hey, we're all excited. There's really cool shit happening, but we all recognize that what's happening here is kind of like operating in a vacuum, and that's not going to work. And then in the afternoon, we had this great panel on Bitcoin reaching the next billion. So we talked a little bit about actual adoption. We had a phenomenal talk by Elena Geralt, who's been doing some work on the ground in Venezuela, about how Venezuela should not be treated as a crypto experiment or marginalized as like a use case for Bitcoin, which was really interesting. My friend Jill Carlson and I actually talked about that later on in the day, about people using human suffering as a way to market cryptocurrency, which is just like, oh, that thought just baffles me. It's vile, and I think it's just so obscene that I can't even begin to think that way. But she raised some really good points. And then I think the overall feedback we got was, everyone just really enjoyed being in an environment where time slowed down. And I think Dan Held, who's on next, actually said that to me. He came up to me, he was like, I felt like time slowed down for 2 days. And it was really nice, because I think in crypto, people feel like things are moving fast. I would argue a lot of the stuff I worked on 4 years ago, I'm still working on, because it really hasn't changed. So it was really cool. I'm just really glad that it was useful and people liked it, because it was a lot of work.
Yeah, events are no joke, man. They are serious things.
It was crazy. August, we had committed to doing it. We threw down our credit cards as a deposit on the hotel. And then in August, I was like, oh, like, we haven't raised any money. And we're all doing this as volunteers. Like, we're not getting paid. So I was like, we should probably like do something, figure out how to not spend all our money on this event. And it worked.
That's amazing. Okay, so one of the themes I want to actually pull out is you were talking about kind of it's almost like the paradox of, on the one hand, there's so much history to learn from and things that we've tried before, and simultaneously this whole slew of new strategies. And then simultaneously on top of that, new institutional investors, or just new participants in general coming in, who are just trying to get up to speed and learning. And we want to be invitational and we want to invite them in. But there's sort of there's this interesting dilemma in terms of where we focus, right? And so obviously, as you know, we were talking with Jake before about all of these new things that funds can do and new ways for investors to invest in crypto networks. But then at the same time, you're seeing sort of the emergence of the first, some of the first big sort of endowments start to come in, right? A big piece of news from last week was Yale making an investment, which is notable in part because, to date, most of or at least the visible LP activity in the institutional space has been primarily family offices versus sort of the endowments and pensions, and also because it's Yale and because David Swensen has such a reputation. So I guess, Meltem, how do you think about balancing, like, as you're thinking about institutionalization and that piece coming in, how are you on-ramping them? How should we be thinking about on-ramping these kind of companies? And, what do you see happening, I guess, over the rest of this year as it relates to institutionals coming in?
Yeah, I think this institutional narrative's been one that's been going on for a while now. And I think it's an interesting one. I think the first thing to ask yourself with this institutional capital coming in is how much of that is a displacement of allocations they would have made into other asset classes. So for example, what I kind of say is like, okay, for most institutional investors, they see Bitcoin and cryptocurrencies like early stage tech investments. Maybe now with Bitcoin, that's maturing a bit more to be like commodity style investing, or maybe it's more akin to late stage tech growth investing. And then I think with security tokens, we're going to see really interesting use case. And I'm not 100% there on security tokens yet. I'm still kind of trying to frame the narrative for myself. But I think we will start to maybe see it displace some private equity capital. I think the real question for institutional capital is it new inflows or is it a reallocation of money that would have gone to existing asset classes? And I think that really makes a fundamental difference from a framing perspective and how people treat these investments. I think what's interesting about someone like the Yale endowment investing, and I've spoken to a number of pension funds and endowments, and I know a bunch of people in the industry have. I think what's really interesting is the fact that in order for an institution like that to make that allocation, they're going to have to create a pretty strong sort of investment memo as to why they decided to make that allocation, even if it's a small amount, because these are typically, fairly low risk institutions focused on asset preservation rather than aggressive asset-based growth. And I think especially like what we in the crypto bubble fail to recognize is at a macro level, all of these revered institutions, institutional investors, they're also under increasing pressure, right? Yields are down. People are questioning performance fee structures. 2 and 20s are under threat. People are asking, well, what's my PM doing for me? A bunch of pensions are going to go underfunded. So there's this really interesting paradigm where you have crypto. Obviously, the market's been pretty volatile. I would say the narrative for some of these things, like not quite making sense with current market prices. But I do think for large cap assets like Bitcoin, Ethereum, I think a lot of institutional asset managers look at that and they say, well, here's a really interesting opportunity for alpha generation. And we're not just talking about 7% like the public equities market, 30%. We're talking about big numbers. And so I think for a lot of allocators, they're under increasing pressure. They're allocating less to venture funds, hedge funds, PE firms, because numbers are down across the board. So I actually think there's a really amazing opportunity here for people in the crypto fund space to pick up some of that capital. The challenge is going to be, and I'm sure Jake already talked about some of this, and I think some of the things Jake and I have chatted about in the past around what Coinfund's doing with their model is really how do you enable traditional investors to build the functional competencies they need to manage a portfolio of crypto assets. And I think in the short to medium term, it'll be them maybe buying indices or ETFs or baskets or other products. But longer term, they're not in the fund of funds business. They're going to have a hard time justifying over a longer period of time, continuing to pay someone a fee for that service. And so I think over the medium to long term, what I'm really excited about is building out the infrastructure stack for the buy side, which are the funds and institutions, as well as the sell side, which is the issuers, to really start to more clearly define, well, how do you do reporting? How do you do valuation? How do you do mark to market? What are industry accepted practices? How do you participate in networks? How do you deal with governance? How do you deal with inflation? Tax, like there are all of these really interesting aspects of investing in crypto assets and then managing those assets that in a way are akin to what I used to do for venture portfolio, which is I think some of what Jake's trying to emulate with Coinfund's model where they actually participate in the protocols. But some of it is also new. And that's where I think there's going to be a lot of opportunity for infrastructure providers, people who build managed services. But the problem is those managed services are going to start to get bundled together because right now it's like, okay, you're paying 2% for your custody, right? Or maybe it's 1%. Then you're paying 2% for networking services, 3% for your valuation. You're paying X% for this. And before you know it, annually, you're paying 10%, 11, 15% of your asset base for these services. That's not going to work. I actually think that's the death of the crypto fund model that a lot of crypto funds haven't started to realize yet, is when these services charge on an AUM basis and they're really expensive, you're going to very quickly run into a situation where people are paying more in fees to service providers than they're actually making on the fund. And so I think in a lot of cases, infrastructure providers in the short term will probably cannibalize their own market, which is where we're going to need to see more collaboration between different service providers to bundle these services, to work with institutional service providers to sort of offer this on a cost basis to really build a long-term viable business. So that was a long answer. I apologize.
I know it. Jake, go ahead.
Sorry. That was really interesting, actually, like this, your last point. And does that, would you say, Meltem, that sort of motivates crypto funds even more to be like even more technical? So maybe they can do custody eventually themselves, or or other services like in-house?
I would definitely say so, but I think one of the challenges is financial regulations pretty well defined in this country and in many other jurisdictions. Hey, Dan.
What's up, Dan?
Hey, guys. How's it going?
Hey, we're just finishing up talking about crypto funds. Your favorite.
Yeah, we're riffing on funds and custody and the sort of the bag of different service providers that sit between investors and the actual asset and what that's going to look like.
And actually, I have to make a disclosure. I'm an investor in Dan's company, Picks and Shovels. So if I say flattering things, forgive me. I will try to be as unflattering as possible.
Amazing.
Sorry. So Jake, I do think a lot of fun, and one of the things I think about a lot, even for what we do, is like, where's the margin going to be if every service provider is extracting their pound of flesh, right? And I think the hard part is like, yeah, it's hard to build these services. The addressable market's really small. And I think this year we saw, hundreds of that are all going after the same addressable market, believing that there are, billions of dollars out there in these crypto funds, and there's all these fees they can earn. But I do think that's probably a little bit of a naive approach. I do think people are price sensitive. I do think people are cognizant of cost, especially in a market where some funds are down. I think Pantera I saw was down 72%. In that environment, I think you become very sensitive to expense ratios. And actually, I looked at starting a crypto fund, and my main reason not to, aside from the fact that I don't know how great I would be at dealing with investors and getting pitches all day. One of the big issues was the fact that the expense base was going to be over 10%, just for all the different services, accounting, et cetera. And so what we're going to start to see, I think the smaller funds are going to die or get merged into the big funds or merged together. And it's really going to be only the big funds that can afford this full stack of back office, mid office, and network infrastructure services.
Cool. Just last quick question for you, Meltem. When you say 10%, are you referring to like of AUM?
Yeah, of AUM.
Okay, wow.
Economics, like I wanted to do it more as a side project, but I did the economics. So for very bare bones fund where you have a fund admin, you have legal setup, you have audited financials, it was going to be, and then you have some basic infrastructure costs. It was going to be 10% a year in expenses.
Mm-hmm. Wow.
Stuff. And I think, again, you can do it more cheaply, but now we're seeing the SEC is going to start to go after funds because some of these funds that were selling their tokens were selling securities illegally because they are not licensed or authorized to do so. So I think, again, unfortunately, this is one of the reasons actually why I think Gemini and Coinbase and Circle are going to be more successful and have such a lead on the rest of the industry is economies of scale, right? You need a tremendous amount of capital to build a business that's regulatorily compliant. And unfortunately, that's true on the infrastructure side. And now it's true on the fund side, on the buy side, which is one of the reasons why I joined forces with CoinShares. I was like, wait a minute, I could build this on my own, or I could work with someone who's been doing this for 3 years, has all the infrastructure, knows how to do this. To me, of those two options, like not being on the phone with lawyers till 1 a.m. every morning, trying to figure out how to not go to jail, option D sounds better.
So this is actually interesting. So when I was talking with Dan, we were talking about what would be fun to chat about. So one thing for sure is I want to hear a little bit more about what prompted your monster thread, which just had a bajillion retweets around the sort of equitability of the Bitcoin distribution initially. But the other thing that we were talking about is this idea of unseen narratives, right? So, for people who know me, one of the things that I'm most interested in are, this is such a reflexive space where it's not just investment, but also people's energy and attention and interest and what they decide to build is so new that of course it's going to be driven by what we're talking about, right? Like what people believe is possible is shaped by what they see around them. And so one of the ideas that Dan was saying is he thought there were kind of like a bunch of different emergent and unseen narratives. And so, Meltem and Jake, I think that this idea of crypto fund just cost being an actual barrier to, scaling management of funds in the space is it's kind of one of those unseen narratives, right? And the potential for just fund consolidation is another one of those unseen narratives. So Dan, let's bring you into this. Can you give everyone just kind of a quick 20 seconds on who you are and what you're doing?
Yeah, so I'm Dan Held. I'm one of the co-founders at Picks and Shovels Co., and we're building Interchange, which is a portfolio management tool for institutional traders. And we thankfully have Meltem as an investor. Nathaniel, like you and I were really jamming on this earlier, and it was kind of fun to go through this exercise, which is, what we're seeing right now is there's this quantum foam of different potential narratives that haven't really peaked above the surface. And what are these unseen narratives where, upon critical observation, we've got all these narratives. We've got everything from stable coins to potential regulatory enforcement, positive and negative narratives, and what actually comes out of that under critical observation. And it's really fun to think through what are future potential positive and negative narratives and how will they move this market. And what kind of prompted our discussion was around Bitcoin Gold being delisted from Bittrex. This is one of those narratives that I hadn't seen before. And Nathaniel, you read about this a lot in terms of just narratives and how they drive this market. And I think it kind of that wasn't one on my list. And I've thought about this a lot. So it's still interesting to think about how many narratives haven't come to pass and how many none of us had predicted to become a narrative became narratives, whether that be forks, stable coins, all those sort of things.
Yeah, I think that one of the things that's interesting too is, so for me, part of the reason to call narratives out is I think that they are inherently marketing, right? There's always someone who has an interest in every narrative or sort of the opposite of whatever the narrative is. And I feel like by sort of highlighting them early, it's less about trying to give them weight and more about trying to minimize the volatility that they create when there's one piece of evidence or not, right? And so that's what I think is about this delisting is a great example of that's a narrative that could spin into a chaotic set of sort of bearish feeling very quickly, or it could also be posited as just a relatively positive advancement that reflects like real challenges and liquidity in the space, right? So that was one of the things that I thought was kind of interesting about that particular narrative that you had highlighted.
Yeah, and then on your last, is this what would you call this, a vlog?
I don't even know, man. It's a conversation. Someone called it around the horn for crypto, but
well, so Travis I think called this out where he combined TA with narratives around fund redemptions, and he was kind of worried that this might become a narrative as well as the 1-year lockup period is coming up soon, combined with some TA. And so I thought that was pretty interesting in terms of kind of that came up in the last conversation you guys had. But yeah, I think we're going to see some interesting things come to pass here. I mean, there's a lot of projects that are doing okay, and there's some that aren't doing very well. And so what exchanges continue to support those crypto assets despite declining volume? I'm not sure. If the chance of a 51% attack increases, then the exchange has liability. So for them, they may have a real financial interest in delisting crypto assets as the risk of a 51% attack becomes very, very high. And not many people are talking about this, and you're right, it's good to have these conversations now before that narrative hits you like a wave.
Nathaniel, can I ask Dan a question?
Yeah, absolutely.
So I think one of the interesting questions I have, we now see some exchanges like Coinbase investing in protocols. And there are other exchanges and platforms that have different relationships with tokens and the teams behind them. I guess to what extent do you think that's going to influence tokens that stay listed, get listed, and what do you think the implications are for the space overall? Because, I talk about conflicts of interest often, and it's funny, last week, a couple of people accused me of not disclosing things, which I found kind of hilarious, but I'd love to hear what you think that means for disclosure and just the relationships at play there, because I think it's one of those really tricky, kind of thorny topics that rears its head from time to time. But I think in a bear market, it just gets so much uglier because there's so much more at stake for people.
Totally. And
I want to, Dan, actually, let me add one thing from the live chat, which is happening right now. Someone had asked, it very much relates, Meltem, to what you were just asking. Any comments on how the lack of information disclosure and transparency / tribalism in the space affect these unseen narratives? So it's a kind of a different dimension in the same vein.
Yeah, so I think it's kind of funny how there's such a lack of transparency in a market that is building blockchains, which are transparent ledgers. You know, it's pretty wild how much, you know, the space is the opposite of that. And so I think I'm hugely for transparency and disclosure. I think that is a very moral thing to do across all industries. I think it clearly defines where your skin in the game is, which I know is Meltem's favorite word. So, you know, I think it's critical that these exchanges and other service providers clearly lay out why they made the decisions that they did to list certain crypto assets. And I think Coinbase has done a pretty good job of that, where they've gone through and walked us through their methodology as to how they're listing these assets. And as well, I think businesses can do a really, really critical role on the executive level. So this is all efficient market hypothesis, strong efficient market hypothesis, where insider information is probably already factored into the price. So executives can create firewalls around certain types of information. For example, when a crypto asset will be listed, and publicly disclose when that crypto asset will be listed when they disclose it to their employees. So I think compartmentalizing information like that, publicly disclosing it amongst both internal and external parties, can minimize a lot of this, I think, concern around the favor, you know, listing crypto assets where you tip off a certain number of insiders.
So speaking of transparency and listing, let's do a round of hot takes on Binance's news today that they were going to be, 1, transparent about all listing fees going on, and 2, donating those all of those fees to charity. Anyone have thoughts on this?
The skeptic in me says, great job virtue signaling. It's good that money is going to charity, certainly. I think the question is, why not do that sooner? I think every firm I've worked at in the crypto space has had really strict policies. Any trade over $1,000 has to be cleared by, or any investment, any trade, anything over $1,000 has to be cleared by compliance and the executives of the firm who have inside knowledge, to Dan's point. And then the second thing was anytime we had a new product, new announcement, anything launching, there was a 2-week trading ban, both before and after, for all employees and affiliates of the firm who may have had associated information. And I don't, like, all of this exists in finance. I come from finance. I'm like, I don't understand why it's so hard for people. So I give Binance credit for being the first to move on this. I think here they're probably responding to pressure from Coinbase. And I'm kind of the skeptic, and I say they're probably trying to buy themselves some good favor. Although I think Binance, in the eyes of the crypto community at this point, can do no wrong. But I think they're kind of behind.
I +1 with Meltem there. I think it's a little bit virtue signaling, even though I love CZ and I used to work with them back at blockchain.info. You know, it's a little hard to kind of pick apart what the real message is there. I mean, they're not running a charity, they're running a business. So why even have listing fees at all?
Yep. I'm probably the least educated on this one, Nathaniel, but thank you for calling out that news. I mean, the cynical part inside of me would be like, well, what's the charity, and is it really relevant to what they're doing?
It's actually they own the charity, so that's a Nick.
Oh, interesting.
It's connected to them, which I think is less relevant from like a financial underhandedness perspective, and more a just a question of like how conscientious it's not necessarily, it seems not to reflect the like beginning of a large gifting strategy, but I mean, who knows?
How is that related though? Because they're paying their employees who work for them to spread their virtue through this charity. Like, this is what I don't understand. It's like people running ecosystem funds who are charging investments 2 and 20. I'm like, I don't.
Exactly. Like, should companies be running ecosystem funds with their ICO raises? And by the same token, now we've gone into kind of charity world. You know, it seems like a nice gesture. Well, let's hope for the best, but there's a question there around like appropriateness, I think.
Here's an interesting question. Just this is totally theoretical, because this is the first thing I thought. Would this news, like, would this actually be better if they had completely ignored the second part of this announcement and just said, all of our listing fees are transparent from now on? Like, every time someone pays a listing fee, it'll be there. Like, nothing about this whole sort of charity piece. It was just the transparency, because it actually felt like where people lost them is like, they were like, okay, cool. Well, obviously transparency is good. And if I'm going to critique that, I might go back and talk about how. But then this charity thing, almost, I feel like it had the feel of something that was added as a way to sort of build goodwill, but actually cut off the more interesting piece, which is just putting pressure on the rest of the exchanges to also be transparent with their listing fees, which seems like a much bigger deal than whatever, you know, hundreds of BTC go to you know, good causes.
Yeah, and I don't think any of us, I mean, there's a whole nother conversation to be had around should exchanges have listing fees or not, but in the classic mainstream financial world, they do. So I think it's fine that they do. And so, yeah, I agree with you that it's kind of weird that they've taken two issues and kind of combined them together, which is one being about transparent around listing fees and the other being what they do with that money. And so I thought that was a weird kind of combination of narratives.
Well, and I would agree with Dan. I think one of the interesting things, I empathize with exchanges, having been on many of these exchanges, having invested in many of these exchanges when they were tiny companies with like 3 people trying to support the May 2017 crypto boom. Like, no one had slept for weeks. Some of these blockchains aren't properly supported. Integrating the wallets is a lot of work. In some cases, entirely custom wallets have to be built, especially if it's not an ERC20. I think the other question, going back to what Jake was talking about, just to sort of loop it on to one big happy crypto burrito, is if you have a protocol that's proof of stake or has some sort of governance mechanism, like, does the exchange vote on your behalf? Does the exchange pick a list of delegates that you can choose from? There are all of these complexities that go into listing assets. So I fully appreciate if people want to charge a fee, but to Dan's point, I think it should be standard. I think it should be completely transparent. While I laughed a bit at Coinbase's Google Form announcement a few weeks ago, and they went on CNBC and shared that they now had an application form that was actually Google Form. I do think one of the things Coinbase has consistently done is create a framework for how they'll evaluate tokens. So if you're a token team, you can at least start to understand kind of what parameters you might be judged on and the likelihood of listing. So yeah, I don't see how this is so revolutionary at this stage. I kind of feel sad that it's taken this long.
Yeah, it was interesting thinking. It feels to me like, in a lot of ways, like if the story of last year was ICOs and the explosion thereof, a lot of this year has been about the exchanges and what you can do on them, and, you know, like what you can trade on and sort of do on BitMEX, regardless of where the markets are. And I think it's interesting, like, these were, you know, along with the mining companies, I guess, some of the first companies to actually come in and just make explosive amounts of revenue, you know, like eye-popping numbers that are just insane, right? Like, I think that we're anesthetized to it, but when you talk to people about how fast Binance became what it was and how much it made, like, it's insane. And it's interesting now that it's almost like we're just catching up and being like, whoa, wait a second, this is one of the most essential, critical, hugely important pieces of infrastructure in the place. And it has, like, it's interesting. So we were talking earlier basically about how the variety of roles that funds could take and what the fund of the future is going to look like. But just last week, we were talking about, you know, who will be in these exchanges sort of organizing block producers in EOS, right? Which is like, are exchanges supposed to, where do exchanges fit as it relates to delegated proof of stake and things of that system? So, you know, the exchange question, I feel like, is going to do nothing but get louder. It feels to me like one of the areas that the world is most likely to look totally different, you know, a year from now than it does right now. So I want to wrap up for you guys because we've been here for an hour, and I really appreciate all the time. We had a couple questions that I just wanted to rip through because I was an asshole last week and totally didn't see the chat the whole time. Here's another one, a hot take. Speaking of exchanges, these bundles that Coinbase, Circle, et cetera, are they a good or bad development, or maybe in what ways?
So I'll take the first stab at this. I think when creating an index or a bundle, the creator should be very cognizant of what they're creating. They're easily mappable to existing consumer mental models of what they see as like an index or a bundle, but I don't think that these represent necessarily the same thing. And I think that should be a little bit more transparent from these exchanges. It sounds nice, and I like the idea, but there's a lot of nuances that are lost in how these are presented, and I think they could do a little bit better job of talking about that.
I think I'll echo Dan's sentiment, and this goes back to the conversation we had on staking and governance as well. I think one of the things we see happening is exchanges are now becoming full stack platforms where they offer everything but the kitchen sink. And I think one of the things that's really interesting is some of these ideologies are sort of antithetical to the approach to crypto. One of the reasons the 2007 ICO boom happened, and I'm guilty of this myself, albeit on smaller scale since some of these massive funds, is people not doing due diligence and forming their own investment thesis for these assets. And so that would be my only concern, is if you have, an exchange offering these bundles, you may have, an uneducated consumer, and that's not the exchange's fault by any means, but you have an uneducated consumer buying a high-risk asset, not really thinking about what they're doing, and then when things go south, I just really worry about the negative backlash that'll create. But I'm sure you have some thoughts as well.
And to kind of add to this, for example, if you went to E-Trade and there was Apple and Apple Cash, and there was no differentiation between it, there was no little info button, there was nothing else, and you went on there as a consumer, and they both look like a U.S. equity called Apple, I think there's a critical component of that of just building trustworthiness within your product, which is critical for all products. And so I think that with these bundles, they're lumping together an asset like some of these assets that are forks, and users don't know what that means. And it'd be fine if they knew what it meant and they wanted exposure to it, but if they don't know what it means, then I think that is kind of that's a critical UX error that's kind of missing right now.
Yeah, I think from a crypto fund perspective, I would hypothesize that most funds would probably not want to get into a instrument like that. I mean, they're sitting here, doing a lot of particular due diligence and particular projects. A bundle seems to be almost antithetical to that. Also portfolio sizing and composition and things like that. And finally, there's, if there are any fees associated with that, that seems problematic. It could be, it could be an interesting way that maybe sort of more hands-off, like maybe even institutional investors could start to get in, but there's also a lot of other opportunities for them.
Awesome. All right. Well, thank you guys all so much for being here. I don't want to keep you. I guess just last thing. First, I'd love for each of you to kind of say where you guys are and what where people can find you. And then second, I guess just for fun, what do you think we're going to be talking about in a month? Anyone can dive in first.
Cool, I'll take that. Probably the easiest way to find us is coinfund.io, and that has links to all of our blog, and follow us on Twitter, of course. In a month, I think just to continue kind of our mining discussion that we started with, I think we're going to see a couple of new networks come up into production. I know a lot of teams are working to have sort of production releases by DevCon, which is very early November. So I'm excited to dig into those and see how we might be able to participate.
I'll take the next one. So you can find kind of my personal thoughts on either Twitter or Medium under Dan Held or Heddle. I was born with the last name of Held, which is only applicable in crypto to be a funny meme. So I've decided to own it. So you can find me in those two spots. That's where I post most of my thoughts. My product is interchangehq.com. And in terms of narratives that I think we haven't seen, let me pull up my list. You know, we haven't seen like we haven't seen an exchange get shut down. And I'm like an old school guy who's been in this space for a while, and I'm like, I've survived, right? And so I think we still have kind of like largely discounted that counterparty risk of a big exchange going down. And I'm not trying to like throw FUD around or try to make people afraid, but I think it's, you know, it's always persistent, but right now no one's talking about it, and that's why I want to bring it up.
All right.
All right. So places you can find me, Twitter. I'm Melt_Dem. I have open DMs and I try to respond to most of them, or in threads. I like to use Twitter for conversation and thought exploration. So all are welcome to participate. And then in terms of things I think we'll be talking about in a month, I think one of the narratives I'm really interested in that I think is getting a lot more attention in different ways is governance. Just all of the complexities related to governance. I think less so in Bitcoin and Ethereum, but I think more so in some of the newer protocols, particularly where people sell governance tokens to VCs and funds. It's like a little bit, it feels a little disjointed. It's like, hey, let's give control to a different group of people, but they wear Allbirds instead of, you know, loafers. That's all I'll say on that.
That's awesome. All right, I will have you back in a month to talk about that, because governance is something that I'm thinking about a lot right now as well. It feels to me like the thing we can judge protocols right now on the basis of what we know about them. The only real information we have to judge protocols for the future is their ability to change and adapt, and the likelihood of their ability to do so. So it feels to me like we're probably going to see a shift from governance by default to governance by design over the next year. So that's really interesting. Awesome. Thank you guys all so much again for being here. Obviously, anyone watching can find me at NLW, and we'll see you next week. Thanks, guys.
Thank you, Nathaniel. It was very fun. Take care.
Bye, everyone.